In today's video, we're going to take a look at the S&P 500 along with the NASDAQ futures. The way we'll look at both of these markets is through the lens of our two different volatility setups that we have to trade futures. The first setup is the one we discuss most frequently, and that's our fade setup. That's where price breaches our volatility box levels, so crosses this cyan line, and we then see a move away from the volatility box levels. I'll leave a link to this video which breaks down the specific rules of this setup along with specific examples as well so you can train your eyes. The second setup we'll take a look at involves our volatility trend setup. Here we're looking to play moves into the volatility box levels, and this is all around the squeeze indicators. We have our squeeze signals along with our slingshot squeeze indicators, all of which really revolves around the idea of using momentum to play moves inside of the volatility box. Now, before we dive into any of those, I also think it's interesting to take a look at the volatility landscape, where we can very clearly see that the volatility has increased, especially if you compare it all the way to, say, Jan 17th. From that point, we see volatility increased, 1-2 days of muted activity, and now volatility, the histogram bars here, seem to be much higher compared to what we saw towards the beginning of this month. This, supported with the fact that the VIX is below 20, I think leads to the idea that we're likely to see more volatility setups. Now let's start with the S&P 500 first, and we'll take a look at the fade setups, and then we'll move on to our trend setups. Now at the S&P 500, we had two different fade setups that triggered today. This was setup number one, where price action sold off and we hit our volatility box levels. This is the scalper volatility box, which is our most aggressive volatility box models that we have. We have 5 in total: scalper, then the aggressive, then the doomsday aggressive, then the conservative, and then the doomsday conservative. Think of this as a ranking system. The S&P to the far left, meaning very little volatility. We can still scalp moves inside of the S&P 500. As part of our fade setup, we're looking for price action to breach our cyan entry lines. That's this line right here. And we'd like to then see an edge signal confirmation confirming in this case that we're officially in oversold territory. We got that move along with an entry below the cyan entry line, and assuming you're a little bit more conservative, you even got entries towards the clouds. This allows you to reduce your risk by half, so you're allowed to take a little bit less risk for a slightly greater reward. Otherwise, we have a simple 1-to-1 ratio. Now using this, our risk here on this particular trade was 6 S&P 500 points. We can see that from the cyan line to the outer edge of the clouds, and we're looking for the same 6 points in the opposite direction, which we made in this move up here with this first pivot point. Stop is then moved to break even for any remaining contracts, so from outside of the clouds to the cyan line, and at that point, that stop was taken out as price action reversed. For our second target, we were looking for this gray target line near that 40.70 mark, and we fell just a little short of that. So we didn't hit T2, only T1. So this was setup number one inside of the S&P 500, a nice 6-point gain on the first contract, 0 on the second with the break even. Now our next breach came in the very next hour, but this was just a wick touch. Price came, we hit our volatility box levels, but very quickly bounced up away from there, hitting T1 before really getting an opportunity to enter. So no trade on the second wick, just the first trade so far. The third fade setup inside of the S&P 500, which also gave us an entry, was towards the end of the lunchtime hour. Now, as we've discussed, the lunchtime hour does have lower probabilities associated with it, and we saw that present itself today. Same exact setup, we had price action breach our cyan entry lines, we had 1 and 2 oversold signals. This was towards the tail end of the lunchtime hour as well, and here, instead of seeing that immediate bounce, we instead saw price action come below the clouds, taking out our stop. In this case, that stop was at 3.5 points, so we had a loss here of 7 points, gain of 6 on the first contract, net negative on the fade setup for the day. Now we contrast this with the NASDAQ futures, same exact idea that we're looking at here, but we get to also implement the idea of adapting to changing volatility. So if you remember, in the 7 to 8 a.m. Pacific hour, that's where we had our S&P trade, which was a nice winner. Inside of the NASDAQ here, we saw price action continue to keep going outside of the clouds prior to us seeing our edge signal confirmation. So that's our sign that, hey, there's too much volatility here. Out of the 5 models that we discussed, the scalper is no longer doing a good job of containing price action. So we need to switch over to the aggressive volatility box models. Now inside of the aggressive volatility box models, same idea. Price action breaches our cyan entry line. That's step 1 as part of our setup. We then get the edge signal confirmation. That's step 2. We're officially now in oversold territory. Inside of the NASDAQ here, this required a risk of 41 points. That's from the cyan line to the outer edge of the clouds. And we're looking for that same 41 points in the opposite side. This was also looking for a bounce near that 12,000 mark inside of the NASDAQ futures, and we saw that pan through here with that same 41 points being hit as price action bounced upwards in this move up. Again, T2 on the opposite side's gray target line. We fell short of that, and the remaining contracts were taken off at break even when the NASDAQ reversed into the close. This trade held on much longer compared to the S&P 500, but in the end, the result here was around the same with the second contract being taken off at break even. Here, that plus 41 though gave us a much nicer winner, 820 on the full size contracts, which allowed us to make up for that second trade inside of the S&P 500, the one during the lunchtime hour. Now that we've taken a look at the fade setup, let me also show you an example of our trend setup that presented itself today. We didn't have any on a 1-minute time frame chart, but the next most aggressive chart that gave us an entry there was a 2-minute chart. And this is to help illustrate the idea of playing moves now into our volatility box levels. As part of the trend setup, we have really two components we're looking at. The first is, do we have any one of our squeeze arrows printing? Our squeeze arrows are the cyan arrows that we see on our chart here, along with the pink arrows. And in all of these arrows, all we're looking for is, do we have a squeeze along with momentum on our side? So here, if we take a look, we had two bullish squeeze arrows along with a bullish market pulse line, green all about. That's the valid entry. Pullbacks to the market pulse are preferred for the actual entry price, and we're looking to play moves into our volatility box target lines. That's this gray target line that you see right here. So this is a pre-market opportunity, but helps illustrate that idea. Now let's take a look at the next cyan arrow that presented itself. Here with this cyan arrow, we see cyan arrow, but a red market pulse. No trade, as we don't really have any sort of trend clarity. If this had instead been a bearish arrow, that would have been a bearish squeeze trade where we'd be looking to play moves inside of that target line. But we didn't see that here. Now fast forward a little bit, the 11 to 12 a.m. Pacific hour, or 12 p.m. rather, there we had two more squeeze arrows present themselves. Here we have bearish arrows along with a bearish market pulse. Very clearly sets up the idea that we now have the squeeze forming right here. We can see that with the red and black dots, and we're looking for this squeeze to fire towards the bearish side. Our target, again, one more time, the gray target line that we see right here, and that's exactly where price made a move into before we start to see a little bit of a bounce here inside of the S&P 500. So hopefully this helps to illustrate one more time the two different setups that we have to trade futures. The first setup is a fade setup where we look for moves away from the volatility box levels. The second setup is a trend setup where we look for our squeeze indicators to give us that sign supported with the market pulse in that same direction of the trend where these arrows are printing, and we're looking to then play moves into the volatility box levels. Depending on your trading style, you can pick and choose the setups that work best for you, along with the time frame that works best for your trading style. The 1 minute is real nice and aggressive for something like, say, the fade setup, where it allows you to get slightly better entry points without needing to take on additional risk. Today, that 1 minute didn't give us trend setups. The next most aggressive time frame was that 2 minute. I hope you found this video useful. I'll leave links to both of these videos inside of the description box in case you'd like to see more examples. This video details the two different setups, a little bit more detail, 9 minutes, just focusing on the setup rules. And this video shows you more examples of the fade setup, which is our bread and butter setup that we like to employ most often. Take care, everyone. Good luck trading, and I'll see you in the next update.